Howdy, Jacob here. Today we're looking at Domino's Pizza, hotel, restaurant, leisure industry. I think we've heard of it. It's in the big three pizza chain industry. No disrespect to Pizza Hut or Papa John's, but Domino's is def my fave between the three of them. They have been growing crazy impressively. I think they got a new CEO. I could just be making some up, so I'm not gonna say it. But I thought they got a new CEO in the early 2000s or um, early 2010s, and they've just been putting stores down like crazy. Demand's been going up for them. I think a lot of other people are agreeing that they're one of the best, if not the best, of the big three in terms of pizza. Their deals are, bountiful compared to the other two. So I think it tastes a lot better personally. So, anyways, growth is dampened a bit. The last 3 years, we have 6% year over year, 4% year over year, and actually negative year over year. So if I were doing this, if I were looking at this business in 2019 or 2020, I probably would have put 8 to 10% as a revenue growth figure. So that's just to say that things can change even when you invest in a business. And once you're already invested because you thought it was at a good price, you just have to make sure it's still not an abnormally high price. Or, if you really messed up on your estimations, obviously, then you can reanalyze it then. But I think it's absolutely essential to look at your figures even after you're already invested to make sure that they hold. And as Mohnish Pabrai said, you don't really truly understand a business until you own it. And so I'm sure what he meant by that is you can do as much research as you want beforehand, but once you're actually invested in them is when you truly start to understand the figures more because you're invested in them. Not only you're literally invested in the business. And so that's just something to keep in mind and something to think about. But gross margin increasing over the last 10 years, operating margin pretty flat, but still increasing a little bit. Humongous return on invested capital and return on assets. This reminds me of something like a Starbucks where if they put a location down, 2 to 3 years, that money's already back in their pocket and everything else is just cash generating crazy. So I think that there's definitely a dominance here. The balance sheet does show a bit of net debt here. Let's see if it's capital leases or not. So 114 million cash on hand. They do have some long-term investments, but 56 million short-term debt, 4.9 billion long-term debt. That's a little bit concerning to me because, again, I'm going to have to assume 100% capital allocation on the free cash flow side. And if this is a lot of their free cash flow, I'm going to say that they're going to have to take money away from reinvesting and then giving back money to shareholders to pay down debt. And then only 180 of them capital leases. So that roughly $4.95 billion is going to be 10 times their free cash flow because they have about 500 million production of free cash flow. So a little bit less than 10 years if 100% of capital allocation went to debt reduction. That's a little bit concerning to me. So I'm definitely going to be assuming that 20 to 30% goes to debt reduction, leaving the rest to go to dividends and share repurchases with their current yield at 1.5%. So let's start making our assumptions here. Revenue growth. I still think they can get back to some revenue growth. To me, I don't think they're quite everywhere. I think that, there's still some dominance ahead of them. So I'm going to give them 6%. For margins, I like 11. And then for share change, because let's see, very consistent margins. Share change, I mean, in the past, they need to do 145 million for 1%. So 100, almost 200 million for 1% to offset stock-based compensation. I think that's all I'm able to give them with a dividend that looks like they have increased that historically. So I'm going to increase that by just 1% because it's already a payout that's big enough. I want them to, reinvest back into themselves, which for them will probably show up in the CapEx line by making new locations. But still, I still want them to be growing that way as much as just giving money back to us as shareholders. And then PEs and price to free cash flows, I think they do have some sort of dominance. So I think 18 I'm comfortable with. And with all these assumptions, we're saying it needs to fall 55% before you get the return looking for here. So I'm not going to be too eager to get into it. I think the business is great. But again, everything is the price you pay. given your assumptions. And to me, it's not as obviously cheap. And with the amount of net debt, I'd consider going lower just because enterprise value is a bit higher than market cap. But I think for now, I'm fine with these assumptions. So hope you enjoy the video. Have a great rest of your day.